Good afternoon. I'm Kent Kramer, Chief Investment Officer at Foster Group, and this is our regular collection of financial perspectives for the week ended Friday, June 12th. Just to kind of review, historically challenging times like this can be hard for investors to navigate on their own, so we're here to help. We have over 1,400 clients at Foster Group who we truly care for. It's been our pleasure to help with all aspects of their financial planning and how people plan, invest, and protect and give, especially in uncertain times like these. With uncertainty seemingly everywhere these days, if there's a chance that you'd like to talk with a Foster Group advisor, whether or not you're a client currently at Foster Group, we would certainly welcome that. We're ready to do it virtually today, and before too long, I think we're going to be ready to do it again in person as well. So please feel free to contact us with any questions you have. And if you know someone who maybe is experiencing some of that uncertainty, it might help just to forward this presentation to them. They might like to contact us as well. So let's go forward here and look at the last week. My title this week is Uncertainty Everywhere, because last week certainly seemed to highlight that. Around the country, hotspots for COVID-19 cases began to kind of reemerge in areas as the U.S. reopened. And we also had the protests continue. And so various levels of state by state, they're struggling again with kind of instances of the virus and how to respond to that. People are uncertain as to how much of their economy to open up and how much to engage. In addition, the Fed Chairman Powell indicated that the pandemic could have long-term effects on the U.S. economy, and that's particularly due to changes in consumer behavior and labor markets. We're going to see that in a minute. I think he was just really affirming what most people already knew. This is going to be a long road back, and it's going to be uncertain along the way. There's going to be fits and starts. Last week, initial unemployment claims fell for the 10th consecutive week, which is good news, to 1.5 million. Continuing claims to edge a little bit lower as well, from 21.5 million to 20.9 million. And you can see here one of the things that the Fed was talking about last week is they were giving a forecast for what unemployment would look like going forward. And you can see how high we are right now, with unemployment estimated somewhere around 14 to 15%. They think it might be as low as 9% by the end of the year, but it's still running at between 5 and 6% even in 2022. So it's a long road to get back to full employment where we were just 4 or 5 months ago in February. Other news of the week: estimates about the depth of GDP reduction or recession vary, but the National Bureau of Economic Research, which is the group that kind of gets to say officially when we're in a recession or not, they said that, quote, a peak monthly economic activity occurred in the U.S. economy in February of 2020. That marks the end of the expansion that began in June 2009. So yes, we're officially in recession. Again, something we all knew kind of in advance, but the announcement officially came earlier this week or last week. Other than grocery prices, most consumer prices have fallen over the past 3 months, measures of inflation. Again, this kind of reflects the reality that we're all living with. You can see the chart on the right, the yellow line, food at home. The prices for food at home have been going up. You've probably been feeling that as you've been shopping for your family. All other items experiencing a slight drop in prices just due to lower demand. The chart on the left shows other kinds of service breakouts in terms of U.S. consumer prices. You can see recreation services and outdoor equipment are two areas that saw slight increases in prices, while airline fares obviously saw significant drops as people just ceased to travel starting in March of this year. In terms of market news, global stock markets ended the week lower following 2 consecutive positive weeks in the United States. Treasury yields fell a little bit, leaving leading government and higher quality bond prices marginally higher for the week. The VIX, which measures market volatility, actually had a really serious rise on Thursday, going from 29.41 to 40.61 during a single trading day on Thursday, June 11th. Just indicating again that investor uncertainty is still relatively high, and when those kind of bad pieces of news come out, people can react, or investors can react very strongly to them and very quickly. If we look at our usual set of market measures, again, the S&P 500 index is measured by the S&P 500 ETF Trust, which is just an exchange-traded fund that tracks the S&P 500. You can see it in the light blue. It was down 4.72 for the week. The All-Country World Index ex-US, so stock markets outside of the United States, ended the week about 3.5% negative. And the AGG, which measures the U.S. aggregate bond market, was up slightly, 0.57% for the week. And if we look at those same market indicators for the year 2020, you see that world stock markets outside the U.S. are down between 11 and 12%. The S&P 500 finished the week down 5.48 for the year, and the aggregate is up actually 4.64. So bond investors had a relatively positive return through these first 6 months of the year. One of the questions we've been hearing quite a bit recently has to do with small company stocks. Foster Group often talks about small company stocks as having a premium or an expected return that's higher maybe than the market as a whole. But there's some concern that in difficult economic times, like during a recession, that those small company stocks may not do as well. They're small, they have increased risk, some of them have increased borrowing. People hear about larger companies having lots of cash on the balance sheet, maybe being a better place to weather economic storms like the one they're in. So we thought we'd just take a look at why small company stocks have been part of the portfolio and why this question is getting some attention here recently. Here's a picture of where we've been so far since February. So if the recession officially started in February, what I decided to do is look at small company stocks in the S&P 500 since the official beginning of the recession through the end of last Friday. And you can see the S&P 500 has done slightly better than the small company market. So the SPX represents the S&P 500. IWN is an ETF representing the Russell 2000, which is an index of small company stocks. If you look back at the end, kind of the end of March, around the 23rd, we remember, maybe not very comfortably, that the Russell 2000, as measured by the IWN, was down 38.45% as of March 23rd from February 1st, when the recession began. The S&P 500, from the beginning of the recession, was down almost 31% at that point, near the end of March. You can see the recovery so far, at least how much they've gained back. But why company stocks for the long term? Well, this is kind of a chart that gets everybody's attention. If you look at the darker blue line on top, that's the Fama French U.S. Small Company Research Index. Dr. Fama and Professor Kent French, they did a study, along with many others, that showed small company stocks have tended to outperform large company stocks over longer periods of time. We decided to look back to 1946. You can see their index of small company stocks versus the S&P 500 shows significant outperformance. People would look at that and go, oh, well, I guess small company stocks tend to perform better. Here's a different look at that same data. This measures that small company premium, the amount of outperformance of small company stocks over large company stocks on a year-to-year basis. The blue bars in the chart represent years when small company stocks outperformed large company stocks. During the red bars show years when large company stocks outperformed small companies. Over time, this one goes back to 1926, the average premium for small cap investors has been just a little bit over 3.5%, 3.79%. The thing you also notice about this chart, while the average small company premium is 3.79%, there's been very few years when that premium has been kind of the return of the year. Most of those premiums are either much larger or much smaller year by year when we look at the difference between small and large company stock performance. You can see recently, in the last 3 years or so, small company stocks have tended to underperform their large company counterparts. And people are asking, well, is this kind of a permanent indication of maybe large company stocks taking over? Or should we be waiting for something called a reversion to the mean, where over time there's a difference in those premiums, small to large, but they tend to even out. So after periods of time of large company performance, you get a period of time of small company outperformance, which again causes that mean reversion effect, which we talk about. Some key ideas around small company stock investing. Small company stocks have provided higher returns than large company stocks on average over many longer investment time periods. Now, small company stocks have also been more volatile than large company stock prices. And if you look at that, 3 and 5 year worst returns have been lower for small company stocks, while 10, 15, and 20 year worst returns have been lower for large company stocks. And you can see this on that chart. Since 1946, while the 5 year downside worst cases have been lower for small companies, negative 12% versus a negative 6% for the S&P 500, the 10 and 15 year worst cases have been lower for larger companies, with the S&P losing 3.43% versus 2.36 gain for small companies on the 10 year. And if you go to the 15 year, there's been a 4.37% worst case scenario for small company stocks versus a 3.76 worst case scenario for large company stocks. So a little bit of a mixed story there in terms of which one has the worst case scenario depending on the time period that you measure. maybe some statistics might help, particularly as we look at recessions and how small companies and large companies do in and coming out of recessions, is in this data here. Again, I'm using the Fama French Small Cap Research Index to represent small company stocks in the US, and the S&P 500 to represent large company stocks in the US. What I've done here is we've looked at recessions going back to 1948. You'll see the begin column is the month that the National Bureau of Economic Research said the recession began. The end month is the month that they said the recession ended. And then the 12 months later is if you held the stocks for 12 months following the end of the recession. What I did is I was just comparing the returns of small companies versus large companies using those date definitions. So if you look at kind of the return for the entire period from the beginning of the recession through 12 months after the end of the recession, what you can see here is that small company stocks have had an average return over that entire length of time of 13.5% annualized versus the S&P 500 of 9.9% annualized. In terms of batting average, what I've done there is say, well, how often do small companies outperform large companies relative to that holding period from the beginning of a recession to 12 months after the recession ends? And what you find is small companies have outperformed large companies about 64% of the time over the time frame defined like that, while the S&P 500 batting average in that same time period was obviously the difference, 36.4%. But the really interesting one I thought was to look at just 12 months post-recession. So as whether it's before we were looking at the return from the beginning of the recession to 12 months after the recession is over, this time period is just looking at those 12 months post-recession. And if you think about that in terms of where we are today, we're in recession today, and we have been since February. So we don't really have a chance to go back and undo what we were doing at the beginning of the recession. What we have a chance to do right now is decide what we're going to do forward. So let's think about if I'm holding small company stocks today, what am I expecting based on historical performance going forward in terms of, is there a decent probability that small company stocks would outperform large company stocks in those months and years after the recession is over? And here the data is even more striking. Again, looking at the same two indices, the Small Cap Research Index from Fama French and the S&P 500, what you see here is the average return for those small company stocks for the first 12 months after the recession is over. The average return for those small company stocks has been 29.2% annualized versus the S&P 500, also a great return, 8.7% annualized, but obviously small companies have had a stronger return historically coming out of recession than large companies. The batting average number is the one that really caught my attention, though. That's been the case in terms of outperformance, small company versus large company, over 90% of the time. So 10 out of those 11 recessions have seen small company stocks outperform for the first 12 months post-recession than the S&P 500 representing large company stocks. Is this going to happen again? Well, we really don't know for sure. Each instance is different, and certainly this recession was brought on by something that we haven't seen since the flu pandemic of 1918. So anything's possible here, but the idea is when we look at stock performance coming out of economically different times, difficult times, as described by recessions, what we see here is small company stocks have done relatively well, even though they're a riskier asset class to invest in some ways just because they're smaller, they may have less cash on the books. There's some things that make them riskier or less stable, but at the same time, investors have been rewarded with higher returns historically by holding those riskier stocks. So the point here is not that we should be putting all of our money in small company stocks thinking the recession might be over soon. The point here is if you're holding small company stocks today, there's a reason. There's a reason why people have been small company investors in the past and why they might choose to be that in the future, because when you look at times, even economically difficult times like recessions, small companies have done relatively well and over longer periods of time have tended to outperform large companies. I ran across this quote from one of my favorite authors last week, Morgan Housel. He writes on a blog called hosted by the Collaborative Fund. But he said this, he said, people don't want accuracy, they want certainty. He was writing about why sometimes we're a little blind to probability. And really what we do is we like people to tell us the way things are going to be with 100% certainty. Fact is, the future is just not that certain. And so when we talk about probability, even when we talk about small company stocks, they don't always outperform. They've tended to perform better. There's no guarantee that they'll always perform better. But in order to be accurate, we want to give you the facts. We think there are probabilities in favor of small company outperformance, but we can't say that with any certainty. There's a lot of things in life like that, and maybe like this quote where I saw it this week. So thanks for attending this week. Again, if you have any comments or questions for the team at Foster Group, you can contact us in these different ways at our website, through an email. And again, if you'd like to meet with an advisor or have a conversation, of course, we'd welcome that. Please contact us at your early convenience. Again, thanks for joining us this week, and we hope to see you real soon.